Thank you all for tuning in. Now, I can't promise you the outcome that you're gonna get from watching this, but what I can tell you, if you apply what you're about to learn, this will change your financial future. If you're here, it's probably because you're ready for change. And what you're gonna learn in tonight's training will do just that. So if taking back control of your money isn't enough to keep you glued to this screen for the next 90 minutes, I think it's time to reassess your priorities. Number one, you're gonna learn how to take back control of your money. And you're gonna do that by learning how to be the bank. Number two, you're gonna learn how to build wealth through your own debts and expenses. And you can do that without working harder, without working longer, and without taking on any additional risk. And number three, you're gonna learn how to get all the money back for every single car you will ever buy, drive, and own. That's exactly what you're gonna learn in tonight's training, so get ready, get set, let's go.
Take back control.
Tuesday night.
Tuesday?
What if by changing one thing, everything would be better for your family financially? How many of you would make that one change? And how many of you want more money in your life? That one paradigm shift and new skill set is the gap between where you're at today and the wealthiest families. So welcome. Congratulations for being here today. High five your neighbor or just high five yourself, because many people could have been here today and they chose not to be. But you're in a small percentage that has shown up for yourself and for those that you love. And that's just awesome. So in the next 6 hours, I'm going to let you in on a little known secret, a little known fact that the wealthiest families and visionaries like the Rockefellers and Walt Disney have been using this strategy called the infinite banking concept for ages to build and preserve their empires. The strategy is simple, it's legal, and it's something that each and every one of you have access to. And it all starts with changing how many things? One thing. Start loving yourself more. So put your hand on your heart. Start paying yourself first. Shockingly, America, we're last in line for our money, and we're giving away a big chunk of all of our money every time we get paid to the bank, to the government, and to Wall Street, to those guys over there. And I'm going to show you how we can take back control from them. Would it be okay if I share a little bit about myself and why I'm so passionate about this subject? Is that okay? Let me tell you, imagine this. Imagine they offer you a position where you have a ton of new responsibilities, a ton of upside, and when you take on that role, you find yourself leading thousands of people, working 30 extra hours a week, and having no equity in the $30 million division that you've built over 5 years. Who here would take that offer? Nobody, right? You'd have to be insane to do that. Well, then it gets worse. I find myself a year after that in the back of a mastermind as one of the leaders, while the leader is leading this future vision exercise and everybody's imagining how much money they're going to have, where they're going to be, where they're going to go skiing, where they're going to go to the beach, what kind of cars they're going to drive. And they're so excited. You know what happened to me? In that moment, I broke down and I started crying. And doesn't matter how many times I tell this story, I go back there and I can feel that pain of letting down my family, failing my family, my boys, my wife, myself. And when that was happening, what I realized when I came back to Orlando is I had a lot of issues, a lot of stories around money that weren't serving me. And so I got humble. I went to a friend. I asked for help. And I called him and I said, hey, man, actually, I went and saw him in person. I said, hey, man, I need help. I need a financial philosophy. And he handed me a book. And I went home and I read that book on a Tuesday. And don't be impressed. It's only 91 pages. But I got angry, really angry. And I reread it the next day. And I thought if this was true, every single American would do this. And this became my mission. And by the end of our time together, you're going to know the secret the wealthy know and how to do it. You're going to know how the banks take your money and make tons of money from your money you work so hard to earn. They're experts at putting our money to work. And you're going to know how you can give yourself a raise and recapture all of the interest, turning your debts into assets, along with truly creating generational guaranteed legacy and the resourcefulness to pass it on. A few years ago, this was something that wasn't available to myself and my family. Because why? Because I wasn't ready. But once we applied this, we went from having $3,300 a month leaving our family to having thousands of dollars a month coming in passively. And today, I'm going to show you the same secret that's changed my family's life. What I would ask each and every one of you is, you might be thinking, Jason, this is unattainable. We're here because we want change, but I promise you this is within your grasp. It's only changing one thing. And my only request is that you keep an open mind and that you understand that if you don't know what I'm talking about, you just don't know it yet. If there's a wall of numbers and you don't understand it, just say, hey, it's cool. I just don't understand it yet, because everything that we change, everything that we want begins with the way we think and changing that one thing. So let's jump in. Now, Nelson Nash often talked about that the infinite banking concept was an exercise of reason, logic, prophecy, and imagination. And as long as you're not driving, remember, I want you staying safe here. The object is to help each and every one of you. And as I go through this, you're going to learn a lot of things that you don't want to miss. So make sure you're sticking around. But I want you to imagine this. Close your eyes if you're able for a moment. And I want you to go, for some of you, in the way back machine to back when you're in high school. And you're surrounded by all your peers. You've just graduated, you're a senior, and you have someone on stage, and he's asking, how many of you are going to be financially successful at retirement age? You guys are going to go nuts. Hands are going to be flying up. People are going to be yelling out, and they're going to say, ooh, me, Jason, call on me. I'm going to be the next Zuckerberg, the next Elon, the next Jeff Bezos, maybe the next Warren Buffett or Donald Trump. You all believe in that moment that you're going to be wildly successful, because at that moment, everything is possible. Everything is possible. And then something happens. It's slow, it's insidious, and it's barely perceptible. But over time, in the decades to come, a shocking statistic becomes our reality. And this comes from our Social Security Administration. This becomes our reality, where only 5 out of 100 people at retirement age are financially secure. Now, financially secure does not mean wealthy. All it means is that they don't have to go back to work. They're not a teller. They're not working at the local grocery store or gas station or greeter or something else that we see a lot of our elderly doing. And they're doing that not because they want to, maybe some, but mostly because they didn't have enough money at retirement to support their lifestyle. And that's just nuts. That is nuts. We live in the greatest country, in the greatest time in history, with the most technology. We're the most interconnected. And the information is all out there for each and every one of us to take, to put to action, and to have results with. And so when you see this statistic, you have to think, this can't be a reality. Now, you are all in that 5% because you've shown up for yourself and those that you loved, and you're already committed to making a change. And today we're going to go through this, and you're going to see how you can make that change. And remember, we talked about how it's going to start with the real estate between our ears. And there's a great quote from this guy, Will Rogers, who, just read that, take a picture of that. The problem in America isn't what people don't know. It's what people think they know that just ain't so. And isn't that the truth, folks? Read it again, one more time. The problem in America isn't what we don't know, right? In the pie, this is what we know. The rest is what we don't know. It's what we think we know that just ain't so. And I'm going to take you through this, and I'm going to show you some examples of people that you know that have been talking about this and utilizing this simple process of changing one thing for decades to build wildly successful empires. Not just the Rothschilds, not just the Rockefellers, not just the families that kind of built the world, but the people now, the people that are currently using this system. And so Let's talk about the people that you might know. And the first one, I already popped it up there, but he wrote Rich Dad, Poor Dad, right? Had a rich dad and a poor dad. And then Second Chance, Robert Kiyosaki talks about this. And I've actually seen an email sent from Kiyosaki to one of my peers, one of the other practitioners, right? There's not a lot of us. And just talking about how if people understood this, that like I've said at the beginning, everyone would do this because it is just foundationally a guaranteed way to grow and control your wealth. And then there's a big guy who changed my life, and he's way bigger than I am, right? Tony Robbins and Money Master of the Game, section 5.2, talks about the whole life concept. And then we have the book that I was mentioning. I'm going to hold it up for you and then show you on the screen. But Becoming Your Own Banker by R. Nelson Nash. And if anybody reaches out to me, I will tell you how to get this. Now, you have to buy it. It's not free. But is anything in life worth doing that's free? No, most people don't do anything with it. But I'll teach you how to read it. I'll tell you how to read it. I'll give you what I learned for paying $2,000-$3,000 to learn this stuff, and I'll pass it on to you for free, gladly. And then you got my peers, right? You got my peers, my partners, Brent Kessler, Chris Naugle, writing their modern version, their story, mapping out the millionaire mystery, which is what we're here to show you today. Anyone here want to be a millionaire, dream of being a millionaire? If that's you, you are in the right place. And finally, Chris Naugle wrote another book because he realizes that the business of banking is the most profitable business in the world. And that's all we're here to talk about is how can you rethink your banking process by changing that one thing. And he wrote the Private Money Guide. And it is great because it shows you how you can start thinking like the bank and creating leverage, putting your money to work. And this is just a few of the things, but before we get into this, let's talk about this interesting concept. And there's my email, jason@jasonsipple. And is it a repeat? It is the same training, but it is definitely live. Whoever just asked that, iPhone. The USA Empire, I love that. So now we're going back to the Wayback Machine for some of you. Is anyone here not able to ride a bike? And if you can't, I just want you to imagine it again. But just kind of curious. Now, I love the cycle, right? It's still one of my favorite things to do as I go into my second childhood, I'll call it. And I want you to imagine when you were a kid and you were there or you're helping your kid learn how to ride a bike. When you press down on the pedals, like you push down with your right leg, you push down your foot, and you push down your left foot, what happens? The bike lurches forward, right? And it starts rolling forward. Can you guys feel that? And now you turn to the right. What happens? The bike goes to the right. You turn the bike to the left. The bike does what? It goes to the left. Well, this welder, you can look this up on YouTube. This welder decided, well, let's play a prank on the engineers and put a backwards neck on this bicycle. So now when you turn the bike to the right, the bike goes left. And when you turn the bike to the left, the bike goes right. Does anyone here think they could ride that bike? And if you do, like I think I could because I cycle so much, but that's just my ego, right? Because my brain, my plasticity, my neurons have been programmed to do it the same way over and over and over again. It's like skiing down a slope over and over and over again. And as I'm going down the slope, I decide, hey, I'm going to go off trail and go over here. Well, as soon as I do that, things get a lot harder, right? Because it's unknown territory. It's the same with our brain. Imagine if this is how money actually worked. Imagine if you could hold space that everything that you think you know about money might not be true, just like trying to ride a backwards bicycle. And we have to reprogram our brains to be able to implement this process. And so let's jump into this. Let's start defining or create some common definitions. The mysteries of money. What is your definition of money? I say it's nothing more. I'm going to make it simpler. It's a means of exchange, right? We give a money for home, home for money, money for car, car for money, money for candy bar for money, right? We're just buying and selling things and using it as a means of exchange. And now, same thing, who or what company uses compound interest? And you might have said in your mind, oh, I know, Jason, call me, it's the banks. I said, well, that's a great guess. But actually, when you walk in, like if Elizabeth walks in and puts her name on a $100 bill and hands it to the teller Does that teller go back to Elizabeth's box, her safety deposit box, and tuck that $100 bill in there and just sits there and waits for her to come back? No, no. And I'm going to show you what the banks actually do with the money coming up, right? I'm going to show you how they keep it moving because banks follow natural laws. And the natural law is things that are in motion have to stay in motion to be what? To be healthy, to make more money, like our bodies, right? Our blood needs to keep circulating. That's why we all have to move every day and exercise or water. You don't fish or drink from a stale pond, correct? So these are just a couple things to think about, that there is no company that uses compound interest in how they run their business. And are your dollars worth more today or in the future? And if you have a hard time with this, I just want you to think about your favorite candy bar. But think about when you were a kid. If I went to the local convenience store or local, is actually a bait shop. It kind of looked like Grumpier Old Men, right? It was red. It had worms outside of it. You could buy pizza and milk. But if I went in there and got a candy bar and I gave the teller $1, I could get like 2 or 3 candy bars. It is a long time ago, folks, but I could get a bunch of candy bars. Well, today, if I went there and brought that same dollar bill and tried to buy a candy bar, I'm not even going to get a candy bar, right? Because one, they're giant size. They made them so big, but they're like 3 or 4 times as expensive. So Elizabeth, your dollars are actually, and it's, it's a very common thing what you put, but your dollars are worth more today than they will be tomorrow, right? Today is the most valuable that your money that you own and have will ever be. Every day from here, it's going to slowly lose value. So what do we do with that? How do we keep up with inflation? That's what we're here about. And taxes, are they going up or down? But if you have any confusion around this, go to usdebtclock.org. Check it out. Again, I wouldn't believe anything I'm telling you. Everything I'm telling you requires you to go do your own thinking. And then finally, I want to tell you a story. What do you know about your retirement account? Elizabeth, I'm going to use you again because your name's right there. But Elizabeth, and everyone that's listening, I want you to think about yourself going into a partnership with myself. And in this moment, I am your Tio Sam, right? I am Uncle Sam, your favorite uncle. And we're going to go into a partnership together. And here's how it's going to work. In this partnership, we're going to be 50-50 partners. Cool? And Elizabeth, the first rule of our partnership is that you, as my partner, as Uncle Sam's partner, are going to contribute all of the funds or money, right, capital into the system. So you are going to be growing our business from the money that you're putting into our business. Cool? Already, Elizabeth's probably a little uncomfortable. And if you're playing along in your head, maybe you are too. But you know that I've done this with millions and millions of people. So my track record must be pretty good, right? So next, Elizabeth, the next rule I'm going to lay out for you is you're going to be in charge of it fully. You're going to decide how much you're putting in. You're going to decide how much you contribute and when and all of the things. But again, it's you. You're the only one putting the money into our business. You're in charge of taking that little tiny seed and growing it to a big harvest. And I make all the rules. Yep, that's right. I can tell you when you can access our capital, because remember, we're partners. I can tell you if there's any penalties to access the capital, and I can decide when you can use it and what your requirements are on how you can use it when you finally build it into this great big harvest. And I'm not done yet. Okay, so next, so far, you're contributing all the capital. I make all the rules. You build it, I get to manage it in a way. And now at the end, what's going to happen is you're going to get to the time where you need the money. You're going to take that $1,000 or $10,000 in the first year or 16,000 or however much you're putting in, and you're going to grow it to hundreds of thousands, if not millions of dollars. And then as your partner, right? I'm a 50-50 partner with you. I'm going to walk in. This could be, I don't know how old you are, Elizabeth. So this might be 10 or 15 or 20 or 30 years from now, but I'm going to walk in. Maybe I'll just sidle in. I'll saunter in. I'll look cool. I'll be like, hey, psst, Elizabeth. Hey, I'm going to need that 34.5%. Nah, let's make it 37. 37 sounds sweet. I've been a little reckless with our money. I haven't been really, following what I like people to practice. So I might have spent more than I have. So I'm going to need that money. Hand it over. That's the unknown, the taxes, right? So how many of you still want to be in this partnership in your retirement account? And I'm not saying that they're not useful as a tool, but when I looked at this, I no longer wanted to be partners with Sam. Elizabeth says, not me. I get John saying, no, thank you. So that's something I want you all to think about. If anything I said shocked you or made you say, that's interesting, that's a clue to dive deeper. And if it made you uncomfortable, that's okay. That was a little bit of the point here, is I just want you to understand that the way that we are taught to give up control of our money and we're taught to assume all the risk is not for you and me. It's for them. Remember the them I talked about? Wall Street, the government, the banks. And so let's take this a step further. Let's start jumping in and talk about what we're going to talk about today. Let me show you the 3-step method. Let's talk about mapping out this method. So it's only 3 parts. The first part is going to be the machine. I've already told you it's infinite banking. I've already told you it's whole life, but I'm going to go deeper into what the machine actually is because there's so many misconceptions out there. And I want you all to be completely empowered after our conversation today. And then we're going to have the marathon, because the biggest opportunity for each and every one of you is to think longer term, myself included, to start thinking in decades and centuries, thinking long term of what we want to happen, because it gives us patience and it gives us certainty that what we can accomplish over 5 or 10 years is so much bigger than what we can do in the next 12 months. So we're going to talk about the marathon. And then we're going to talk about the millionaire, right? I asked who wants to be a millionaire here. If that's you, stick around because I'm going to show you how one of our clients became a millionaire by just changing that one thing, And I don't even bring it all the way to the end because there's probably over $1 million that he ended up with by just changing that one thing, where his money was going first. But first, let's talk about this machine. What is it? Now, this is the point when I'm live that some people have to go to bathroom breaks. So if I saw you, I'd tell you, sit down, right? If you're getting ready to zone out and do something else, maybe you're looking at the radio or driving, this is when you really want to focus because this is telling you exactly what you need to know. The machine is nothing more than a dividend-paying whole life insurance policy from a mutually owned company. Said differently, it's a specially engineered whole life policy from a mutually owned dividend-paying company. All of these things. The privatized system process that's away, right, from them, bringing it back to the you and me level. But what is it not? Now I've told you what it is. Maybe take a picture of this and take a picture of what it is not. It is not any of the following things. We are not. Hear the word not, because sometimes our brains can't differentiate, right? It is not IUL, VUL, UL, or term. What are those, Jason? It means that in a universal life, the policy is tied somehow to the market, right? In an index or variable. It's tied. It was supposed to be made, back in the 90s to give more clarity for life insurance. And what I've seen is it might be good for some things, maybe retirement, maybe other things. They all have their place, but they do not have a place with infinite banking. As a certified Nelson Nash infinite banking practitioner, I actually signed paperwork that says I will never use an IUL or sell an IUL to help anybody with banking because why? It takes back control from you. And if I'm here to serve you, it's the exact opposite of what I'm stating I'm here to do. Everybody cool with that? Understand that? How it puts you in control only through dividend paying whole life insurance from a mutually owned dividend paying company. Oh, by the way, all the ones we partner with are the same ones that we use for our personal banks, all 5 of them, and they've all been profitable every year they've been in business, well over 100 years. So let's get interactive now. So grab your pens and papers or your crayons. I like markers. I got a bunch of markers on my desk. Say, grab a marker, maybe go to your whiteboard and draw a T-square. And this is something whoever has, if there's multiple people, whoever has the best handwriting, I want you to be the one in charge of this. So in the top left, you're going to write the bank, and the top right, you're going to write policy. And underneath both, you're going to write liquidity. What's your definition of liquid or liquidity? Mine's probably cheekier than yours. So maybe you wrote it down and you said, hey, Jason, just means I have access to my cash, access to my capital. I can get it easily. Yes, I'd say all of those are true. Great answers. And How about it's not locked up in financial prison, right? It's not locked up where TO Sam is telling you, "Psst, hey, you can only take up to half of what your retirement account is, up to $50,000, if that, right? Depending. Now, if you have a high yield savings, I need you to do me a favor and pop what the rate is that you're getting in the chat. Now, I've been watching this over time because we do this presentation often every Tuesday. That's why it's Take Back Control Tuesday. And I've been seeing the rates slowly go down. So if I could get some rates here, see, I'm used to seeing rates around 4, 4.2, 3.5, 3.75. But if you don't have a high yield savings, then just on your paper, probably write 0.07 or 0.01 because that's what the average bank is going to be paying you on the money that's being stored in their system. Now, under policy, write 3.25. That 3.25 is G number one. Guarantee number one, contractually guaranteed, can never be worse than that. And that's one of the 5 companies. That just happens to be where all 4 of my policies are. Okay. And now under bank, for anybody who does have a high yield, oh, there we go. Thank you, Yolanda, 3.6. But all of that growth inside your bank account is taxable growth. Okay. Now, in a policy, it's tax-free. And it's actually tax advantage is the proper term, but it's tax-free growth, it's tax-free loans, and it's tax-free distribution. And then under bank, you have unstable. And again, let me define that for you. If you said, Jason, what do you mean by unstable? What's that mean? To me, unstable, think back to the beginning of 2023. You had, remember the Silicon Valley Bank, you had Signature Bank, you had 3 giant bank failures, all over $100 million, 100 to 200, billion dollars each. I said million, but $1 billion. Could you imagine just having a $100 billion company go bankrupt like that? Well, that's happened over 500 times since 2000 with the banking system. Why does it happen? That'd be my next question. Well, banks practice fractional lending. Imagine this. Yolanda, you put $10,000 of your hard-earned money in the bank. Well, the bank is only keeping 1,000 of that, right? Because they're going to lend out 90%. And through a series of loans, which I'm going to show you this more, but through a series of loans, they're going to turn your 10 grand into 100,000, but they're only keeping 1,000 at reserve. That's what fractional lending is. So the banks, if you've ever tried to take out a large sum of money over hundreds of thousands of dollars out of a bank, they might tell you to come back in a few days because they don't have the money. They're going to have to go from one of their banks that support them to get the actual money. This is why banks fail, because when people get nervous and they go get their money from the bank doesn't really have our money because it's all out working. Under policy, we have stability. And this is a product of being whole life insurance. And they have to guarantee that the death benefit that they guarantee is available and liquid immediately. And they're also stable because they practice what's called Austrian economics, which means that the money is backed by something when you take a loan. You know, think back to the gold standard, back to 71, right? When we used to be able to turn in our bills for a silver certificate for a piece of silver or gold. It was backed by God's money. Hasn't been like that in a long time, but the way that these large mutual companies work is every dollar is backed by a dollar. So if you want to borrow $100,000 and you have $100,000 in cash value, that is how you're creating that leverage. So everything is accounted for. They're not creating money out of thin air. It's just a better way. It's a non-inflationary way to do banking. And there's more to that, but I'll talk to you about that when you perhaps schedule a call with me in the future to learn how this applies to you directly, which I'll get to that in a bit as well. And in the bank, the next line on the left side is unprotected. What's that mean? So we have our entrepreneurs. Anyone else? Entrepreneurs, ease. For those folks that are entrepreneurs, think about your business. If someone gets hurt on a property or gets hurt and someone sues you, we're in a very litigious society, right? One of the big wealth killers is what? Attorneys, especially here in Florida. They're all over all the billboards. And we got Yolanda as well. Awesome. So for you lady entrepreneurs and everyone else listening that's an entrepreneur, when you're not protected from attorneys, guess what? That means that your business could be fragile. It could be threatened by losing money because someone sues you. Well, with the system, right, with the infinite banking concept, with the specially engineered whole life, your money's protected because it's state statute and it's protected from liens and judgment. In Florida, fully protected, fully privatized. It helps with a lot of things in life, especially being an entrepreneur. And so far on the left side compared to the right side, on the right side, we have it is tax-free, guaranteed growth away from our favorite uncle, protected from our favorite attorney, and a stable environment that's been profitable for the last 100 plus years, in this case, 148 consecutive years, and is absolutely liquid within a few days, like 3 to 5 days typically. And we didn't even get to the cherry on top. So far, if you're comparing the left side to the right side, which side's winning? And now let's go to the cherry on top. Now we were talking about living benefits. Let's talk about the cherry. So on the bank side, let's say you have 100 grand in the bank, you take all the money out. Does it do anything else for the ones you love, for the ones that you're looking to protect, right? And provide for? No. When you use the money, you've used the money. Hopefully you bought a cash flowing asset, but it's gone now. Under the policy, you have a tax-free death benefit that's guaranteed. That will be a multiple being like if you put in 10 grand, you probably have 100, 200, 300, $400,000 death benefit, whatever it might be, right? Depending on your age and all the things, the carrier. But you're going to have a guaranteed multiple that's pretty large. That's tax-free. It's a tax-free guaranteed estate. So knowing all of this, where do you think that your bank is putting their money? If they asked you, now that I'm putting all of you on the board of directors of your bank, so I'm asking you, or your bank is asking you, where do we need to store our money? The bank's money. That has to be safe. It has to be protected. It has to be accessible. And it has to be guaranteed to be growing. Where do we put our money? On the left side or the right side? You put it in whole life. And this is what banks have been doing now. Since 2012, they're the number one purchaser. They have 4x the amount of whole life they own, and they own over $225 billion of this stuff. Remember what I said? Do your own thinking, do your own research. This is what I have found, and I put this together because I learned where a lot of us are storing our money in the bank, and they're not using their system. They're using whole life. If you ever wondered why there's so many VPs and executives at a bank, now you know. They need an insurable body. Isn't that wild? So now that we've established that, let's do another banking exercise. And since Kelly's giving me smiles, Kelly, it's your lucky day. You're going to buy a car. So Kelly, come on down. In this car, you see it has all the modern technology. It has the big, glorious panel where you can see everything that's happening in your music and everything else. It is going to be amazing. And Kelly, if $25,000 isn't enough for your new car, just add a zero because this equation will work the same. Now this, I'm making it exciting, but is a test to see how much you trust me, Jason, your host, and in this instance, your banker. Okay, Kelly? Now, Kelly, I see how hard you work. You work hard. You're disciplined. You pay yourself first, following the first law of wealth, at least 10%. And you've been storing your money in my bank, in Jason's bank. And you've been doing this for a while. And you've saved up 25 grand. And you come to the bank and you're all looking spiffy. You're about to go get your new car. And Kelly, we want to know what color car is your car. And is the interior leather? Is it pleather? What kind of interior do you have? What color is the interior? Everybody wants to know. And just imagine that new car smell. And you come in to the bank and it's your day. You're so excited. You've been working so hard. You're going to get this new car. You can see it. You can feel it. You can't wait to test drive it. And when you come in, I'm like, Kelly, congratulations. I give you a high five. We exchange pleasantries. And I'm like, Kelly, I've got an offer for you. I'm going to offer you the deal of a lifetime. You leave your money compounding at my bank, earning 4%. And I will give you a loan, right? So you can go to the dealer for the amount of money you need. We're going to collateralize your bank, the money you have. And I'm going to give you a loan for 6%. And at the end of 60 months, which is 5 years, right? 5 times 12. At the end of 60 months, you will make money earning 4 and borrowing at 6. Am I telling Kelly the truth? She just got her new car, but am I telling her the truth? What do you all think? Survey says no. What? Elizabeth, I was so nice before. Elizabeth says, Jason, you're a liar because 4 minus 6 is -2. I am crushed. I don't know how I'm going to get over this. But when I'm looking at it, I used to say the same thing, and it's okay. But I want you to know, look at the math. 25 grand at 6% is 483.32 a month. The future value, Kelly's going to pay $28,999 for her $25,000 car. So the bank's going to make how much? Almost $4,000. But I'm paying Kelly at 4%, and that future value is $30,525. So I know we got folks from all over the country here, but is 30,000 more than 29,000? Yes? We on the same page? All right. So in fact, I was telling the truth. Well, how's that possible? This is why I wanted to show you this, because I want to help you rethink what you think to be true. We're rethinking your thinking so you think differently. So I thought that you thought that this was going to be about thinking, and this is how we did this thinking thought exercise together. Got it? So, on the one side, you have an uninterrupted compound interest. Now that's taxable interest, but you still made $1,526. And just think, Kelly, if you bought a Ferrari for $250, you would have made $15,000 earning at 4. And now this is what we want to teach you. This is what it is to become your own banker. I want you to stop looking at the percentages and start thinking about what is your money doing that. Write that down. What is my money doing in this situation? Right? And the reason on the depreciating loan value that she paid $28,999 is it was going down in value as she was paying it off over those 5 years. Does that make sense? And so now let's jump into the banks. And in the middle here, if you guys are already thinking, oh my God, Jason, I've seen this before. I have to have this conversation with you. I can't believe I've been watching your videos, Chris's videos, everybody's videos for months, listening to you guys and Ask Me Anythings. I've been doing all of the training. I'm ready to get on the mat. But you can scan that QR code, right? And if you're new here, make sure you smash that like button, subscribe to the channel, and watch us in this next video, but scan that and make sure that you're booking that free strategy call so you can learn how you can take back control of your money by changing one thing. But let's talk about how the banks are making a killing. Just think about how nice their buildings are and where they're located in your town. You're going to put the $100,000 into the banking system. And I'm going to continue being super generous, and I'm going to lock in my rate at 4%. Unheard of, right? I showed you most banks are paying 0.07. You saw Yolanda's at 3.6. I'm going to continue giving you 4% because I'm such a lovely guy. And now when you put the money in, now you got a new job. And with this new job, you want to have your kids in a better neighborhood. So you're going to buy this big, blue, beautiful house. And when you buy the house, they're going to charge you about 7% these days. And that money leaves and goes to the house, right? You take a loan, you go buy the home. And then what's the seller do? They bring it back to the bank. They bring it back to my system. And now that you got this beautiful blue home, you can't keep driving that beater. You better hide that thing in the garage, but you could drive this sexy BMW, couldn't you? And so now I charge 7%, right? You're making 7% for the home, shorter duration, 8% for the car. Money goes out. What happens? The money goes where? It comes back, right? The dealer brings it back. And now your spouse wants a remodel, or maybe your kid wants a pool. And so now you leverage your home, right? And you do a remodel. You take out a 9% loan, and the money comes back where? Goes back to the bank. You see how it's leaving the bank and coming back to the bank. It's leaving the bank and coming back to the bank. And so far in these 3 instances, how much risk has the bank taken on? Hardly any, right? Hardly any, because they have an asset that's collateralized. And now you're super excited. You got this big house, you got extra rooms, you got things that you had to decorate. You forgot that the sprinkler system didn't work when you moved in, and you had to add that because otherwise all your grass would die. And so now you take out a bunch of credit cards and you have to do a debt consolidation because all the 0% turned into 25.5%. And now you're one of the millions and millions of Americans with over trillions of dollars of debt. Okay. And so now you take out a debt consolidation and they give you this fair rate of 12% compared to 25. Hey, that's half. That seems great, doesn't it? And that money goes where? Back to the bank. So you're making 4%. Let's see how much the bank made in each of these transactions. So we got 8 minus 4 is 4, right? 9 minus 4 is 5. 12 minus 4 is 8, and the first one is 7 minus 4 is 3. We add these together, and what do we get? We get 20%. We get 20%. And so, folks, 20% is more than 4, yeah? We agree with that? We cool with that? How much more is it? Is it 16% more, or is it 5 times more? I'm going to show you that it's 5 times more, right? 4 times 5 is 20. 5 times more is actually 500% more. The banks are making, on average, sit down if you're not sitting down, 400 to 1,300% on every dollar annually that you leave in their system. They are masters at making money with your hard-earned money. How would you like to know how to do that? That's what I'm showing you today. You got to start somewhere, right? These banks just weren't blossomed overnight. It was time, thinking, leverage that they create, right? They kept creating additional, like once one business is successful, what do? They duplicate it and start another branch. Now, how many of you would like to know an alternate way, a better way to finance every vehicle, every beautiful truck and car that you ever buy, right? Every that you buy, drive, and own. Who wants a better way to do this? One that you keep control of the scenario and you end up over time making money. You want to see that? And I'm going to show you, like, we're lifting the hood to the machine right now. And I'm going to define a few things. When I talk about premiums, right, your life insurance premiums, we're going to call them deposits because you're opening a banking system. So they're called premium deposits. We're not going to worry about your age, whether you're 21, 31, 41, 51, 61, or 71 years old. This will work the same way as long as you are insurable or have an insurable interest. So age doesn't matter. The cost is not affected with this. And the death benefit, super important to myself and my mission for fathers, but it's not what we're talking about with the banking process. So let's look under this machine. So Kelly, you were such a good participant earlier. You were so happy about your car. So now you're going to say, Jason, I liked earning money. That was pretty good before when I made $1,599. I would like to know how I can make more with all of my cars I ever buy, drive, and own. And so now, Kelly, you're going to create your own system, your specially engineered whole life policy. You're going to make a $10,000 a year deposit. And if you all believe what I believe, the wealthy have more choices. Is that a fair statement? If that's fair, Kelly, you can make your premium deposits monthly. You can make them annually. You can go back and forth between how you make them every single year. It's a simple change. But you're going to make the deposits. Sorry, I'm getting a little ahead of myself. And in year 3, you're going to have enough cash value to go buy another $25,000 vehicle. And remember, if you're buying a Ferrari and you're putting $100,000 in a year, then you're buying a Ferrari in year 3. But either way, this works. The math works. And you buy the car. And this time, since it's Kelly's banking system, and Kelly's definitely an honest banker, I could tell just by her comments. And she's going to pay herself at $500 a month. So $6,000 a year, she's going to pay her system back, that loan back, over 5 years, just like she would if she took the loan from Jason's bank earlier. And now over the period of time, let's do the math. $70,000 over 7 years, 5 years of paying the loan back, 30 grand is $100,000. Minus 25,000 equals 75,000. Well, let's look at our cash value there. We've got $75,000 of cash value in our policy, and our cash value has grown to $67,881. We've actually gotten 91 cents of every dollar for making this purchase back into our system already. That's what it looks like when we recapture the interest that used to go to the banking system. And now, just to drive home this point, I'm going to do something completely insane, something we would never, ever, ever instruct you to do. After year 7, Kelly, you're going to be a little bit crazy and you're not going to put any more premium deposits into your system. You're going to stop financing your bank, stop capitalizing your system, which was the number 2 principle in this book. Okay. Capitalize your system. Don't be afraid to. But now you need another car. Your car is a little beat up. It's a little smelly. It's a little scratched up. People, at the grocery store, they don't really respect things and they swing open those doors. And in this second car purchase, you're going to, again, be an honest banker and you're going to pay yourself back. So now after the next 5 years, what have we put into the system? $30,000. Can we agree on that? Of Kelly paying $500 a month back to her system. She took the loan in year 8 at $25,000, and she has a net of $5,000, right? 30 minus 25. Then how has the policy grown by $23,592? And car number 2, Kelly has actually made money. How many of you think this is a better way to purchase a vehicle? Or how many of you think about, once I show you the rules here, this is probably a better way to purchase everything. So the 3 rules we have to follow are: pay yourself first. If you're listening to this and you're wondering, how can I get started? The first question I want each and every one of you to ask yourself is, are you paying yourself first? Make a note of that. Are you paying yourself at least 10%, maybe 20% of every dollar you earn into an account that you don't touch? Do it as if your life depends on it, because it actually does. Rule number 2, I would say follow rule number 1. Rule number 3, follow rule number 1. But no, rule number 2 is pay yourself with interest. Rule number 3 is recycle and recapture all of the money, which is why you're creating this banking system. And like I said earlier, if this works for a car or a truck, what else can it work for? Everything, right? So let's talk about debts. Anyone here paying a lot of interest to those guys over there, to the banks? Anybody? Whether it's your mortgage, your car, a credit card, is anyone paying a lot of debt to someone else? If you are, if you want to eliminate debt rapidly, and if you're not here to eliminate debt rapidly, that's okay. Just watch what most Americans have in front of them. This is an actual client case study, and I'm going to talk about some new software that we're using and show you a little bit of that during this. Thank you, Frank, for being honest. And now, this is a client who came up after one of these presentations. And the client asked, hey, Chris, how can I do this? Or can I do this? And you know what Chris said in very Chris fashion? I don't know. Depends. Depends on what? Well, it depends on your habits. It depends on how you're treating money. Are you paying yourself? Are you saving money? And this client, this is a 45 or 46-year-old man, shared, yeah, I am actually. I'm putting about 25 grand a year into my qualified retirement plan, right? He was a doc, a chiropractor. And this chiro putting 25 grand a year into his policy or into his account. And look at his debt profile. This is what the banks, this is a no plan. The banks want each and every one of us to keep doing this, because why? We're giving them $5,777 a month for 19 years. Whew! Wow! I've never said it that way before. That's a lot of money. And we asked the doc, will you change one thing? Will you change one thing, where the money goes first? He said, yes, if it helps me pay off debt faster. If it helps me take back control and recapture this money, I'll do anything. Anything? Cool. Let's jump in. So in year 1, we just moved that $25,000 that was going towards retirement. We open a specially engineered policy for this guy. He takes out the maximum cash value immediately, and we define that as the first 30 days. And what's he do? He pays off Discovers, he pays off Lowe's, and he pays down Nordstrom. Immediately recaptures almost $500 a month, right? $448 a month. Year 1. Year 2 does the same thing, makes the same deposit. Watch what happens. The cash value goes up. Every year, the cash value is going to go up, no matter what. It's guaranteed. It actually gets better every single day, guaranteed. And then you're probably earning a dividend as well. So now he's got $16,571. What's he going to do with that money? He's going to pay off Nordstrom, Wells Fargo, and the private loan. He's going to recapture now almost $2,000 a month, $1,917 a month. Are you guys watching this? Only 2 years, and he's already cut out more than half of the debts that he owed someone else. And now notice, every time he pays off a debt, what is not happening? He is not going and saying, ooh, I got a new $276 a month or new $271 a month. We can now go get more subscriptions, more streaming services, more vacations, more going out to eat. No, he took over that debt, and that money flows back to him. It used to flow out to the families, and now it's flowing back to this chiropractor. You guys following that? So it's a big circle. In year 3, deposits the same amount. And look, something really cool happens in year 3. Now, often this will be sometimes year 3, but often this is going to be year 4, year 5, year 6, where every dollar we're putting into our system is going to give us more than $1. And that is the efficiency point. And this is a little bit older example illustration, but no matter what, that at some point you're going to hit the efficiency point, and every dollar you put into your system gives you more than $1. And that's exciting. That's $541 of new tax-free money above and beyond. And now he paid himself back to 23 grand, knocks out the Beamer, the blue Beamer, the boat that matches, and now we recaptured more than half of his debt. 3 years in. Remember, the second principle after I showed you the machine was a marathon. In years 1, we put in 25 grand, 2, 25 grand, 3, 25 grand for a total of 75. Loans, max loans every year, 55,000. How much is left in this policy? Is it 20,000? No, it's actually $75,000. All of the cash value is still in the policy. Because remember, we're borrowing against that money. So let's keep going. We're making something pretty boring, pretty exciting. Remember, this is only something that's changing once per year for this doc. He's not working any harder. He's not doing any more work. He's not seeing any more patients to make this happen. He's just changing that one thing. He makes the deposit, cash value grows again, payments back to himself, knocks out the condo. 5 years in, we're one debt left. $1,221 left to recapture. Now in year 6, something interesting happens. He can't put the full 25 grand into that policy number 1, right? So it's like if I ask you, hey, can I put more than 12 ounces into this awesome Christmas 12-ounce mug? You say, of course not, Jason. But what do I need to do if I want more coffee than 12 ounces? I either drink some or I need to get a second mug. And that's what this doc does. He gets a second mug and opens a second policy. So now he's got one that's $10,000 a year, gives him $13,000 in cash value. The new one, 25, gives him $14,863. Add them together plus the payments back, 82 grand, more than enough to pay off the home and start paying all of the money back to his system. So within 6 years, right, that's 72 months rather than 19 years. That's what it was before. If we follow their plan, right, this is what I'm going to show you next. Their plan versus a customized for you plan, the best plan is going to show you that when there's no strategy, that debt payoff is going to take a long time and you're going to pay a ton of interest to the bank. And now where you take back control of that, in this scenario I'm showing you right here, I just grabbed one from an existing client last night. It's going to take this person 34 months, and they were doing about the same contribution, about $28,000 a year. They overfunded by a little bit, but within 34 months, they had paid off all their debt, less than 3 years. So the bank's way, and this is what we'll show you with every single strategy call, is if you have a plan, you have debt, and you want to recapture, or you're building for an opportunity fund, we're going to show you a roadmap of the math and how it works before you've ever signed or funded a policy. Why do we do this? Because we know this works and we need you to know as well. We need you to know the only way it doesn't work is when you look in the mirror. But in the scenario, look at their plan. Look at the red, 63 grand paid to the bank. Our plan, the best plan, you recapture $30,920 of that 63 grand. Almost half. And since you paid yourself back over the next period of time, now you have a $181,000 opportunity fund. And then look at the death benefit, right? And that's going to vary from person to person, depending on your age, depending on how much the plan is, the carrier, all those things. But just the point being, their plan is for them. Wall Street, the government, the wealthy making money on your money. When you decide to be wealthy and we customize your plan, this is what it looks like. And this is what we do in every strategy call. And so remember how I was asking you if you want to map out the millionaire mystery. So I get this fun question for you. How do we eat an elephant? Anybody remember? One bite at a time. And as my wife always says, Jason, you got to don't start at the ears, start at the bottom and work your way up. And the man or the woman did not fall to the top of the mountain, did they? No, they had a struggle step by step to get to the top, right? And that's why there's so few people willing to hike that mountain, because it takes work, but it's simple. We're only changing that one thing. And so, as I said, I was going to show you how that chiropractor ends up being a millionaire by changing one thing. So over time, if he just did what the banks wanted him to do, and now since he took over that note and he paid himself back, each of the notes, look, he's going to recapture just from the house and the condo. We're not talking about the Beamer, the boat, the other things that he still has to pay himself back for. $493,967 over the next years. And wait, it gets better. And why? Because all of that was growing at a guaranteed interest rate and probably earning dividends. So we're giving you an easy 4% internal rate of return. That's $750,000 brought back to this client, this actual client's life. Do you think that was impactful and changed his lifestyle? And we didn't even show paying back the boat and Lowe's and Discover and the personal loan, right? That's how I said it's mapping out the millionaire mystery by changing just one thing. And then hopefully he took that money he recaptured and he put it out to work and created cash flow. So now that you've seen this, if you're not doing this, aren't you stealing from your kids and your grandkids and everyone that you love? As Warren Buffett said, if poor people would just do what rich people do, they wouldn't be poor anymore. And to Warren's point, I love that quote. I don't even know if he said it, but I do love it. To that point, we starts with our thinking, with the real estate between our ears. And so now that we're almost at our end of our time together, in a second, I'm going to show you how you can book that strategy call with me. And what I just showed you has been what's been happening and what's been the wealthy I've been doing forever. What we just learned is how the banks make 400 to 1,300% annually on your money. And again, that's nuts. And how many of you would like to make that kind of return on your money? If you answered yes, even in your head, we're going to show you we showed you how you turn your debts into assets. If you don't have debts, that's great. Now you just build an opportunity fund. We showed you a better way to finance all the things that you'll need while keeping control of your money and protecting your family. And that's the power of becoming your own banker. Banking is a verb. Do you know what the most common thing that my clients say to me? I had someone say this morning. Jason, I wish I would have known this 20 years ago. And here's the crazy thing. Do you know who knows about this? Rich people. And I guess they didn't let you in the circle. Well, ladies and gentlemen, welcome aboard. You now know how the wealthy build their foundation and how you can do the same. And only one of two things are going to happen as I'm showing up here on the screen. You're going to live or you're going to die. My question is, are you better with or without this process? Thousands of people have been right where you are in this very moment, tens of thousands actually. And while you're at that fork in the road, you have to decide, are you going left or are you going right? And if you decide, hey, it's not for me, not yet, not at this time, no worries. I still love you. I'm still here to support you. But if you're ready for a change, if you're ready to change one thing, I know I can help you. If you're worried, stressed, or frustrated, I've helped thousands of people like you take back control because they were ready to. Scan the QR code and have a conversation with me. And if you don't, no worries. But no matter what, I appreciate you for your time, your energy, and your dedication to yourself. That shows me you're ready to change. The question is, will you? I'm super grateful to be part of this community, to be part of your lives. So thank you. Thank you for taking the time, your dedication, the fact that you stayed through this whole thing, even though some of you have seen this before, says a lot about you. So be blessed, keep growing, keep learning. If you haven't yet, scan that QR code, get your free session with me, and we'll go from there. Be blessed.